So, what are some of the most misunderstood terms used in the mortgage industry? Well, let's start with number one. What is the APR versus your interest rate? So APR, commonly confused for the interest rate. Your APR is not actually the interest rate. APR stands for annual percentage rate and is the cost to obtain the mortgage over the term, call it 30 years, expressed as a percentage. Your actual interest rate is the percentage at which your monthly payments are based. Number two, closing costs versus settlement costs. Closing costs versus settlement costs. So your closing costs, the best way to explain what those are true costs that you could not get back if you were to sell the home even a day after you closed on it. These are things such as title charges, charges from your lender, government charges. Let's say you closed, you decided you didn't want the house any longer. You've paid these costs, you're not getting any of that back. On top of that, you have prepaid items and escrow reserves. Prepaid items are things such as the interest on the mortgage from the day you close through the end of the month in which you close. You're also going to pay your first year's homeowner's insurance premium. And your escrows are taxes and insurance that are being used and collected by your lender to pay those bills once they come due once per year. However, if you sold the home right after you closed on it, that money is still yours. So you would be reimbursed the prorated portion of those escrows and prepaid items. Closing costs are only your true costs, while settlement costs encompass all of the charges involved with buying the property, which are your closing costs plus your prepaid items and escrow reserves. Number three, FHA mortgages. And are they just for first-time homebuyers? Are FHA mortgages only for first-time homebuyers? Well, actually they're not. FHA does not stand for first-time homebuyer. It stands for Federal Housing Administration. And FHA mortgages are available to anyone who's buying a property as their primary residence, meaning they're actually going to live in it. This is a huge difference between conventional mortgages, where conventional mortgages can actually be used to buy any type of property, primary residence, second home, or investment. So FHA mortgages, not just for first-time homebuyers, but it must be the home you're going to live in. Number four, conditional loan approval versus final loan approval. A couple of terms you can hear once you're in the mortgage process are going to be conditional loan approval and final loan approval. So the difference between the two, conditional loan approval means that an underwriter has reviewed your loan, issued an approval based on you providing or third parties providing additional items or conditions before they can give the final approval. The final approval is what you receive once all of those conditions have been cleared by the underwriter and you're ready to close. Number five, rate lock and rate float down. Interest rate locks and interest rate float downs. So let's say you're looking for a 30-year fixed rate mortgage, but you're not closing for 45 days. How does your lender guarantee you're going to receive the interest rate that they can offer you today? Well, that's done with an interest rate lock. They're locking your interest rate based on the current market, and it's going to carry through all the way to your closing date. Once you close, you'll have that same interest rate for the 30 years if that's what you chose. Now, what happens in a market where rates are declining and you locked, let's call it 30 days ago, at a higher interest rate than what's available today? Well, that's where an interest rate float down comes into play. Some lenders allow you to float down to a lower interest rate once you've locked one time prior to your closing. So in a falling interest rate environment, rate float downs are more commonplace. And those are some of the most commonly misunderstood terms in the mortgage process.